inflations precede recessions, and serious inflations precede serious recessions. In other words, once you allow the inflation to get out of control, then basically you're setting up the situation that will lead to instability on the downside.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. For a good while now, experts, including many of those appearing on this channel, have been warning about the lag effect of the aggressive interest rate hikes and quantitative tightening program conducted by the Federal Reserve and other major world central banks over the past year. These experts have cautioned that the speed and severity of these cooling measures would cause a sharp economic slowdown that could easily result in recession, deflation, and a material correction in the financial markets. But here in mid-year in 2023, the economy's chugging along at a 2% plus GDP growth. Inflation remains at 3%, and the S&P is up 18% year to date, and the NASDAQ up a whopping 35%. So where's the slowdown? Were those predicting one wrong? Well, they weren't wrong, says Dr. Lacy Hunt, perhaps just a little early. But a credit crunch is now at hand that will indeed start freezing up the gears of the U.S. economy. To learn why, we've got the great fortune to sit down with Dr. Hunt himself. Dr. Lacy Hunt is a former senior economist to the Federal Reserve Bank of Dallas, as well as several of the world's largest global banks. He now serves as Executive Vice President and Chief Economist of Wealthion Investment Management Company. Lacy, thanks so much for joining us today.
My pleasure, Adam. My pleasure.
Lacy, it's always a pleasure to talk to you. It's always a graduate level course in macroeconomics. I'm so excited to jump into it with you. Very quickly before I do, I just want to give one quick disclaimer that this interview is for educational purposes only, and folks watching, Lacy's not advertising Wealthion Management, nor is he soliciting business for Wealthion here. He's just talking to us as a private individual and a very accomplished economist. With that out of the way, Lacy, let's start, if we can, with a high-level question I like to ask all my guests at the beginning of these discussions. What's your current assessment of the global economy and financial markets?
Well, it is true, as you said, we had in the 2-something growth rate in the second quarter after similar growth in the first quarter. However, I don't think that number is really very representative for a lot of the sectors. For example, the Chicago Fed has a national activity index, which is weighted. Has 80 some odd different components in it. And it's declined for 4 consecutive months. Only 30 or so of the indicators rose in the month of June. There are sectors that are gaining, important sectors that are gaining. But there are a lot of areas of the economy that are weak. One of the things in economics is called a circular flow, which has been proven time and time again, with what we spend equals what we earn. In other words, gross domestic income must equal gross domestic product. But they have different income streams, so consequently, over the short run, there's usually a significant statistical discrepancy. Well, the gross domestic income has declined in 3 of the last 4 quarters. It's dropped in 3 of the last 4 quarters, even if we exclude the losses of the Federal Reserve. Yes, the economy has continued to move forward, but the areas that are moving forward are becoming narrower and narrower. Let me just talk about something that was very apropos to the second quarter. As we know, or as we believe, according to the consensus, that the GDP growth rate was 2%. And there were various components moving up and down. However, I believe the controlling factor, the one that really permitted the second quarter to look good on the surface, was what happened in automotive. Automobile assemblies, according to the Federal Reserve in their industrial production release, surged at just a hair under a 50% annualized rate. Now, the reason for this, in my view, is that this was the last major sector to restore operations from the pandemic. They had various significant supply chain issues. And but in the second quarter, they had a 50% gain in output and about a 10% gain in sales. And as a consequence, there was a very big surge in automobile inventories, and the inventory levels are now approaching 60 days, which is very close to what the companies like to aim for. Okay, so here's the situation. At a minimum, directly and indirectly, automotive production and sales, the whole gross automotive output, is at least 4% of GDP. It might be 5%, but let's assume that it's the lower number, 4%. 4% times 50% means that this one industry gave us a contribution of 2% to GDP, directly and indirectly.
Which was most of the number for Q2.
That is correct. In other words, it was the controlling factor. And even with this monumental benefit, the manufacturing sector has declined at about a 1.3% annual rate since reaching a peak last September. And automotive output, which is your high multiplier, high productivity sector, is 0.5% lower now than it was a year ago. Another element in the picture is that the United States, even with the problems that I've mentioned, which are not generally acceptable ideas, the rest of the world is doing quite poorly. I think it's fair to say Europe is in a recession. China is struggling badly. Japan is doing poorly. And I think that I would summarize it by saying that the economy is far weaker than is generally recognized.
Okay, economy is far weaker than generally recognized. And it sounds like if we look on the surface of some of this headline data, maybe we can tell ourselves that things look okay, but you're basically saying, one, you got to look at the full data set, and two, you got to dig beneath the surface, because a lot of what's driving some of these headline numbers are maybe sort of short-term one-offs, right? I don't expect you think we're going to get a similar boost to GDP in Q3 from the automotive sector.
As a matter of fact, if you look at the automobile assemblies, according to the plans of the automobile companies, and the plans always vary, and there's monthly variations, and there's a strike in the industry that's possible. We don't, but according to the plans, automotive output is supposed to be flat for the rest of the year. So you go from a 50% rate of contribution, 2% of GDP in the second quarter to 0. In other words, it's not going to replay itself in the second half. It's behind us.
Okay.
And so the very great economist who ran the Bureau of Labor Statistics for a long time, George Moore, believed that one of the things, keys to short-term forecasting, was to look at gross automotive output, gross GDP, and look at what was happening to the non-automotive, and then assume that the major swing over the short run came from the automotive sector. Now, automotive is not as big as it used to be, but it's still an important sector, and I believe that what happened in the second quarter was really a reflection of a gigantic move in a major industry. I'm not saying it was not a negative. I mean, it was not a positive. It was a positive, but it's a non-repeatable one-off of positive.
Okay. So I want to spend most of this conversation going through the key takeaways from the recent Q2 letter that you sent out to your clients there at Hoisington. Very quickly, though, just
also an educational document.
Very much so, yeah. So before I do, though, I just want to get your high-level response to this question, which is your letter basically warns of a coming credit crunch, and I'm going to let you really walk through the argument for that. We had an economist on this channel not that long ago, Ed Yardini, And he sort of talked about this concept of a rolling recession, where instead of the entire economy sort of slowing down at once and growth contracting, that it was almost like a relay race where the recession baton was being held to different industry sectors. And by the time one sector kind of bottomed and started recovering, it would hand the baton to another sector. And so you never had sort of a full depression of the economy. You just sort of had this flatline level of growth where you're not going too much above it or too much below it, because different parts of the economy are entering recessions at different times. So he was sort of saying, like, I don't really expect us to see a full contraction. I think you have a different point of view, but the reason why I'm asking you just to sort of comment that on a high level is to this question of people who are saying, hey, all these people have been warning about lag effects and coming recession and all that stuff, but we're not seeing it out there, right? So what would your high level response to that be before we get into credit?
My response would be is that what has happened is the economy in aggregate has continued to move forward, but the number of sectors that are expanding is narrowing, and that the main driving force behind this narrowing in economic activity, the decline in GDI, the drop in the important manufacturing sector, are precursors of what are to come. And keep in mind that additional monetary restraint is still being pumped into the system. Mm-hmm. The Fed has not only done a lot of work, but it is continuing to do work in terms of the fact that the interest rate levels are high. They're scheduled. The market is looking for another increase in July, and even more critically than that, we have reached high levels of real policy rates, and we're seeing a marked contraction in both bank credit and money supply in real terms, which will continue to be a drag against the economy as we go forward.
Okay, so let's tackle each one of those going forward, because you go into them each in your letter. The causal factors for this credit crunch, I think, are several, and you just mentioned a number of them. But doesn't it sort of all start with money supply and velocity of money?
This is the most critical. It starts with the Fed raising the policy rate and shrinking permanent reserves of the banking system. That's where it starts, and then it's first transmitted to money. So money is the first visible indication that things are going to change. And one of the things, I wrote a book 47 years ago called Dynamics of Forecasting Financial Cycles. And it was a large-scale econometric model of the financial markets. And one of the findings that I had in the book, and which is still borne out by the data that's in our latest letter, and which you want to discuss now, is that money supply leads bank credit. Money is leading, bank credit lags. And in the current situation, we've had such a severe contraction in money growth that it is now leading to a contraction of bank credit. In real terms, very large decline in real terms, and actually in nominal terms, bank credit has now declined every month since February. And it looks like that we're in July here, we're just experiencing the second consecutive monthly decline in bank loans. So deposits are coming down. This has forced a change in the bank behavior. It's not to the bank's interest to reduce their balance sheet. When they reduce their bank balance, when they reduce their balance sheet, it means that they're cutting their earnings potential. And that's not something that they want to do. And so the Federal Reserve, by changing money supply growth, then they change behavior. And we're seeing that right now. Now, there are other elements that are coming into the picture because the income side of the economy is not doing well. We're beginning to see an increasing delinquency rate. We're beginning to see an increase in corporate bankruptcies. And this is a reflection of the fact that even though the stock market is extremely exuberant, in an aggregate macro sense, I'm not talking individual companies, looking from the big picture downward, corporate profits are declining. And I'll just give you one very tangible expression of that. The Treasury's tax collections are very sensitive to what happens to household income and corporate income. And so we've gone through two important tax dates in the spring. We went through the April 15th tax collection and then the June 15th tax collection. And according to the Congressional Budget Office, there was a very substantial shortfall in the Treasury's tax revenues. And it hit both the corporate and the household side, which is an indication that the GDI numbers are in fact correct and that they are correctly indicating a weakness inside of the economy. And so we have, you really don't have to dig that deeply at them. You can find confirmation of the problems that are in the economy at a time when the Federal Reserve is still pushing downward on the economy's future economic growth.
Okay, so many questions to follow up with on that. Let me just start with the decline in taxable receipts, which you're right, it shows that GDI is going down because there's less income to tax. We haven't really talked much about the debt side of the equation yet, but we're going to be spending, I think, over $1 trillion this year on interest payment on the national debt, right?
It's approaching that, and it'll be even more next year. The fact of the matter is there's two elements at work. That the Treasury's average maturity of the debt is 5 years. And so, in other words, means that half the debt is under 5 years. And a lot of debt was put on not only by the Treasury, but by the private sector at the very low interest rate levels. So if you put debt on and it was a 3-year note in 2020, that debt is maturing this year. There's about $10 trillion worth of public and private debt maturing this year, similar amount that will occur next year. When interest rates rise and interest expense goes up, what happens is that the income stream from prior projects that were debt financed has to be channeled into interest repayment. Well, interest repayment is extremely non-productive. It keeps you in business, but it doesn't build new facilities. It doesn't hire new workers.
It doesn't bring any marginal new dollars. Yeah.
No, it's basically a dead weight loss. Now, the corporation, the net interest expense this year has not risen a great deal because when the interest rates are low, the corporations very correctly borrowed very heavily. But as we go forward in time and the debt that was taken on in 2020, 21, 22 is going to roll off. And it will contribute to higher interest expense at a time when these monetary lags are working their way through the economy.
Okay, so I just want to underscore for viewers here, we're talking basically about incomes going down, right? National income going down, while at the same time, national interest expense is going up substantially. So we're having this increasing gap that's going forward right now. And you just talked about monetary lags, but I just want to get the question out on the table, Lacy, for the big question of, is the lag effect actually really going to matter here? I hear you saying, yes, just wait.
Well, it's monetary as well as what's happening with regard to fiscal policy. They both operate with lags, and fiscal policy doesn't operate in a way that many people generally expect them to. Let's deal with monetary policy. I believe that the financial cycle leads the business cycle. And I think there's actually three interconnecting sine waves. There's the financial cycle, the business cycle, and the price labor cycle. Now, these lags vary all over the place. And we calculate them, and I will give you some numbers, but we have to understand that the lags vary because they're different initial conditions. You don't have the same conditions domestically in a tightening cycle as the same conditions internationally for each tightening cycle. Another critical difference is the demographics. Sometimes demographics are very strong, sometimes they're very weak. Another element in the picture is the starting point of how high inflation reaches before the Federal Reserve responds. In this particular case, the Federal Reserve did not respond quickly. They let the inflation run. They let it get hot and permeate into the system and begin to affect the wage decision. So the lags are varying all over the place, and it's important to try to distinguish how the initial conditions influence. Now, having said that, and given all of these complications, I would say that from the peak of the financial cycle to the start of the GDP cycle, you're dealing with a lag of about 5 to 9 quarters. Now, by my calculation, the financial cycle peaked in the fourth quarter of 2021. So the second quarter was the sixth quarter. The quarter that we're now in is the seventh. The fourth quarter will be the eighth. The first quarter of next year will be the ninth. In other words, we're still well within what would have been the normative lags. Another element here is the way in which fiscal policy operates. Now, people presume that larger deficits mean greater fiscal largesse. And there are elements of the federal budget that potentially could help the economy. For example, between the Inflation Reduction Act and the CHIPS Act, that adds $1 trillion to federal spending over the next 10 years. And that's believed to be helpful. But I don't believe that it will be helpful. A couple of reasons for that. Number one, there's a great deal of academic research that shows when we engage in deficit financing, the economy gets a lift for about 6 quarters. In other words, the multiplier is positive. But then after 6 quarters, the multiplier begins to retreat. And by the end of 3 years, the multiplier is negative. In other words, essentially what happens is that the resources are transferred from the private sector to the government sector. So let me give you some really hard numbers here. We have the deficit for the first 9 months of the fiscal year, from October through September, through June. And the deficit is $1.4 trillion, which is the same as it was for the 12 months in the fiscal year 2022. Okay. All right. In the first 9 months of the current fiscal year, all of this $1.4 trillion deficit has been funded by the domestic, private, non-bank sector. The Fed was selling, the banks or the agent of the Fed was selling, and the foreign factor was nil. In addition, because the Fed and the banks were selling, the domestic non-bank sector actually purchased not only all of the new deficit, but they bought an additional $1 trillion of Treasury securities, which means that the private domestic non-bank sector retroactively funded $1 trillion of the $6 trillion of debt that was issued in 2020 and 2021. And when that transfer occurs, you're moving resources from the positive high multiplier private sector into the negative multiplier government sector. And so the increase in the budget deficit is another negative. It is not a positive. It is draining resources from the private sector. and it will continue to do so under the current scheme.
Okay, so let me just make sure I fully follow. So the Federal Reserve has been putting its foot on the brakes, if you will, economically with its policies. I think a lot of people think, okay, yeah, but the fiscal side is still putting on the gas, right? We've got money coming into the system.
I would not agree with that.
I don't think you would, right?
No,
exactly.
I don't. I do not agree.
Yeah, that's what I'm trying to address here.
It's outwardly stimulative. It's outwardly stimulative, but when you allow for the fact that the resources are coming out of the private sector, it means that you are actually transferring into the negative multiplier government sector.
All right, and just to help people understand that, this comes down to productivity and how this capital gets used. Lacy has said that on the government side right now, it's actually a negative multiplier, meaning that if capital flows into the government sector, it's actually sort of anti-productive, if you will. And so right now we're seeing this transfer of trillion four, whatever you said, basically coming from the private for the first 9 months of this fiscal year. Yeah, has gone from the private sector into the government sector, and presumably, Lacy, just because it can earn money pretty safely on that capital, right? It's just saying, hey, I can get paid, 5+% at really low rates or whatever. And so that money could be spent productively in the private sector, but it's getting kind of hoovered up by these high interest rates or high yields on safe treasuries, and therefore going from a positive multiplier environment into a negative multiplier environment.
Well said, Adam. Well said. I might say that when it's a little bit hard to know exactly where the deficit for the current fiscal year will be, even though we have less than 2 months, only a little bit more than 2 months to go. But the folks at Piper Sandler, who've done a great job over the years, have a preliminary estimate coming from their policy group that indicates that we're going to run a deficit of $600 to $800 billion in the final quarter of the current fiscal year. In other words, which means that we're going to be somewhere between 1.6 and 1.9 trillion deficit for the current fiscal year, all of which will be funded by the private non-bank sector. The Federal Reserve is basically liquidating about $96 billion a month of government and MBS paper, and the banks are also liquidating. And so by definition, it means that your domestic private non-bank sector has got to give up the resources to fund the government sector.
Okay. All right. So basically what I hear you saying is we really have a Federal Reserve that's trying to cool the economy, and the deficit spending that's going on that many people have thought, oh, well, that's kind of counteracting that. You're saying, no, it's actually not. It's in many ways probably making it worse. You had a comment here. I want to get back briefly to back to our money supply and velocity, because there's a chart you have in your letter that I want to share with folks here, and I want to help them understand it. And it's where you show real ODL, which stands for other deposit liabilities, which I believe you think is sort of a superior measure of money supply.
It is. I firmly believe that, because it does not include currency, which is fading in importance. You can't use currency for large scale transactions, and more businesses don't want to take currency for a variety of different reasons. And it does not include money market mutual funds. Money market mutual funds are not banks. They cannot create deposits. All they can do is attract the existing pool of deposits, which then they immediately shift out in the buying of other types of assets. And so I believe it's a superior measure. And it has another advantage. You can follow it weekly off the Federal Reserve release H1, H8, Federal Reserve release H8.
Okay, and I assume as goes the growth or shrinking of ODLs, so to goes the expansion or contraction of the general economy. So can you tell us what's happening with other deposit liabilities right now. Comment on its velocity, if you will, and then I'm going to tie it all together with a big question after we sort of define this for folks.
Okay. All right. So the Federal Reserve actually throttled back on quantitative tightening during the debt ceiling drama, and they didn't hit their reduction of Treasury notes, bonds, and MBS paper. I think because they didn't want to rattle the market while there was this issue. However, in July, the Federal Reserve has resumed the full-fledged quantitative tightening. And for the week of July the 12th, which is the latest week that we have data, other deposit liabilities dropped by over $100 billion, which is a new all-time low. So we had a transitory slowdown in ODL. It still dropped in nominal terms slightly, more substantially in real terms. But the rate of decline eased because the Fed pulled back, not a policy move, but because of the debt ceiling issues. They've resumed it, and now ODL has dropped to almost 15.2 trillion, which is a new low. When we look at it in real terms, ODL has declined by a record amount over the latest 12 months, a near record amount over the latest 24 months, and it's also now declined for the last 36 months in real terms, which is an indication to me that the huge money mountain which was created in 2020 and 2021 has been reversed. And that compares with a long-term trend rate of growth of 3%. So the money growth, the ODL, is pointing in the direction of additional monetary restraint coming into the system.
All right. So Lacy, as you've been talking here, I've had your chart up of real ODL and ODL velocity, and we can see that real ODL has now been in contractionary mode for the recent 2 years or so, and
it's
that velocity
is for 3 years now.
3 years, okay, and that velocity has just plummeted. I mean, it just took a nosedive here, right? And the trajectory continues to be to the downside, as you're saying.
There's been the 3-year moving average has come down. If you look at the quarterly data, there's been some upturn, but I believe that velocity will turn down for 2 reasons. One of which we already discussed: a substantial amount of the income stream from the debt is going to be channeled into interest expense, non-productive. The multiplier will turn negative. In addition, another influence on velocity is the bank loan to deposit ratio. And it has been rising. The banks have been selling government securities to try to hold their loan base in the face of declining deposits. It is a well-known cyclical phenomenon. But when the Federal Reserve eventually shifts to a monetary ease, the banks will buy government securities, but loans will continue falling. The loan to deposit ratio will come down, and the factors together will push velocity back toward the lows.
Okay. But I take from all of that is just you expect to see a continuation of the trend of money supply as defined by ODL shrinking and velocity continuing to slow, all of which is contractionary for the economy. But you just made a comment, and this is really where I was sort of building up to all this, which is you said the money mountain created in 2020, 2021, which supported spending and inflation, has been eliminated. So on this program, to help people sort of understand the record amounts of stimulus that were put out during the pandemic and the impact that it's had on boosting asset prices and keeping the economy more robust than it otherwise would have been, we've used this analogy of a pig going through a python, right? You've had this massive stimulus pig getting shoved through the python of the economy. And there's been much debate over how much of that pig is left in the python. If I look at that comment you wrote here in your letter, it sounds like you think the pig may be fully through the python at this point. Is that true?
It is, but unfortunately, as I said earlier, there's 3 sine waves that are at work here. There's the financial cycle, the GDP cycle, and then the price labor cycle. And so there's this 5 to 9 month lag between the financial cycle and the GDP cycle. But then there's another 1 to 2 quarter lag within the price labor cycle. In other words, the Federal Reserve actually inflation has been responding more rapidly than it normally does. But in order to get the inflation rate back to the 2% target, that requires additional time. And so let's say that the Federal Reserve doesn't raise the federal funds rate again. It just allows the current system in place. What that means is there will be forthcoming monetary restraint still entering the system. Mm-hmm. But it's still having to work through these lags. And so a return to price stability is still further away. And that's one of the difficulties for the Federal Reserve. When you allow money mountains or you have high money growth, you boom the booms. But because of the lags involved and you cannot see the progress occurring, what you tend to do in monetary policy is slump the slumps. And so the very complacent, widely held consensus in here, in my view, is overly optimistic.
So you were a senior economist for the Federal Reserve of Dallas. So you have a sense for how the institution works and how the people there run it. Presumably, with 1,000 PhDs or whatever that are, available to the FOMC, they should sort of understand what you just mentioned there, right? But it seems the data they're looking at, like, let's look at the employment numbers, right? Unemployment is still relatively low as measured by the government. And do you believe that the Fed may be looking at a number that will move eventually in response to all these lag effects that we've talked about, but it hasn't moved yet? Because like you said, it's sort of the end of the whip there. And basically saying, hey, look, unemployment is still really low, so we can continue tightening more. And therefore, they may be over slumping the slump, right? Because they're looking at data that is so lagging, it hasn't really moved yet.
I think that is exactly the problem. And that's why Nobel laureate Milton Friedman contended that a better policy was to keep money supply growth in a relatively narrow range. Don't let it get extremely high or extremely low. And John Taylor did it with the federal funds rate. In other words, what these two great scholars were saying is that discretionary monetary policy basically fails us in the final analysis. To my way of thinking, the financial cycle leads the GDP cycle, and which is a coincident indicator, and the GDP cycle leads the price labor cycle. Let me just give you one example here that I think is very worrisome. We have experienced now a record 10-quarter decline in productivity. Productivity to me is a major economic indicator. From a standpoint of the well-being of our people, it's more important than any other indicator that I can think of. It's tied to the rate of growth in real per capita GDP, which is lagging quite considerably what it is historically done. And so when you have a situation right now is that productivity is dropping very sharply. One of the consequences of that is that unit labor costs are rising faster than compensation because unit labor compensation productivity productivity is output per worker hour. So when you get a decline in productivity, that means that unit labor costs are rising faster than compensation, which means that in the current situation, compensation unit labor costs are outpacing price increases, which cuts into corporate profit margins. Well, a declining corporate profit margin is not acceptable. Neither is a decline in real earnings of your household sector. And so what has to be done to right the situation is that firms are going to have to rationalize their workforce to bring productivity into alignment.
Okay.
In other words, to get
sorry, just to translate, rationalize their workforce, you mean lay people off?
They are. And if they don't do that, then productivity will continue to decline. Their margins will continue to implode. And it's part of the process of restoring price stability. And so once the firms can no longer take the margin erosion, and you see, because of the stock price strength, there's an assumption that corporate profits must be doing well, but they're not. They're declining in the aggregate sense. And they will continue to decline as long as you have this situation. As long as you have declining productivity, you cannot have a rising standard of living. And so what the Fed is doing now is it's trying to restore the price stability so that we can have a resumption of growth that lifts all boats. When you get into these inflationary environments, it doesn't work for the vast majority of our people. There are only very few of us that really benefit from inflation. Inflation robs everyone, but it robs the modest and moderate income households the most. Mm-hmm. Let me just put a little more contemporary spin on it. Right now, for a variety of reasons, we're getting a little bit of a spurt in commodity prices. They had been coming down, but the oil sector is rebounding to some extent. Production's fallen off. There have been all kinds of distortions that were created by the pandemic. We have poor crop conditions in the United States and elsewhere. And so the commodity price indexes are starting to turn back up. Now, a lot of people are saying, well, that's inflationary. Well, it's inflationary in the sense that the price of basic necessities, fuel and food, will start going up. However, in the current situation, this is not like 20 and 21 and 22, when money supply growth was very rapid. And so what it means is that consumers will have to pay the higher prices for the food and fuel that are currently rising, because they're inelastic goods. They don't have substitutes. Right. But in this environment, that will mean that the consumers will then have to shift more of their resources from discretionary goods into non-discretionary goods, which will ultimately weaken the economy. In other words, you won't have the high multiplier sectors advancing, and so when you get a spurt in commodity prices, such as we're experiencing right now, that actually is more ultimately a recessionary development than an inflationary development, although it is technically both.
So one might say a stagflationary development, but yes.
It is, but at the same time, the monetary restraint's still moving through the system. And the fiscal multipliers, which were initially positive, are now turning negative.
Okay. Yeah, I think that's a key thing I want people to take from this conversation here, which is that those fiscal interventions, resumption of the fiscal, taps, if you will, turning them on to stimulate. The stimulative effect of that is largely gone and now becoming an anti-stimulative effect, which I think a lot of people are not thinking of in that way.
Well, even if you don't buy my analysis of the multipliers, which is well supported, and I gave quite a bit of documentation in the letter, the fact of the matter is, a shortfall in revenue, which adds to the deficit, doesn't boost the economy, and the interest expense doesn't boost the economy.
Yeah, absolutely. So you basically painted a picture for why companies you think are going to have to start laying off workers, because we've been having this chronic slide in productivity here. I'm going to put words in your mouth. Feel free to change them. But do you see layoffs as inevitable? As the necessary medicine needed to try to get productivity realigned?
This is the way I would say it. Inflation's precede recessions, and serious inflations precede serious recessions. In other words, once you allow the inflation to get out of control, then basically you're setting up the situation that will lead to instability on the downside.
Okay. And I'm guessing you would say 9% CPI as we saw last year, that's serious inflation.
You cannot let inflation run hot. It hurts too many people and causes too many imbalances. And the problem is the same that Europe has, the same that by the way, the Chinese economy is so weak that they are actually now a deflationary element in the world. And while the Chinese just announced new stimulative measures, keep in mind that these stimulative measures are hinging on the efficacy of taking on more debt.
Right.
And they're shifting more of the Chinese economy from the private sector into the government sector. Well, but the private sector has the high multiplier, the government sector has the negative multiplier. So in actuality, even though the markets have reacted positively to the so-called Chinese stimulus, the net effect is that it will make China weaker, not stronger.
All right, that's another one I want to underscore then, because again, that's been one of the factors that people have been touting as why we may have a soft landing or a no landing is hey, China's reopening back up here, and that's going to boost the global economy, and we probably did see some initial boosts from their reopening efforts at the end of last year, but it does seem to be, when you look at the data, much more disappointing than hopes were pinned on this, and China did kind of help pull the world out of the global financial crisis.
I would say one of the major factors that pulled us out of a global financial crisis. China was a very lightly indebted economy.
Exactly, and that's where I'm going.
Yeah, massive increase in debt. And by the way, the emerging markets followed China. They were very lightly indebted. Now we have a situation where China is more over indebted than the United States. We don't even know to the degree to which it's over indebted. And the emerging markets are more indebted. And so the initial conditions for the global economy, I believe, are actually worse now than they were in 2008, 2009. Of course, the demographics we know are much worse.
All right, so they cannot ride to the rescue this time. And so even though the market is cheering the recent news that China's going to start stimulating its economy here, you're basically saying, no. I think that's a sign of trouble. It's not a sign of the
more debt is not their solution. The problem is that they're overly indebted. And the only thing that's different is that China feels that the private sector is underperforming, and they're now expanding the command and control economy. Well, expanding the command and control economy moves China further in the direction of negative multiplier activities, not positive multiplier activities.
Okay, so talking about government stimulus for a second, you say in your letter that even if they get the ODLV, the velocity of ODL, if they're able to stop its plunge and keep it stable going forward, you're saying that's still going to severely limit the Fed's capabilities to spur economic growth. What if the Fed just pivots, right? And it just says, hey, you know what? And maybe it gets inflation down to 2%, or maybe it gets worried about the economy, and it says, okay, we're going back to QE, and we're going to start buying stuff again, asset purchases. How could that change the story here? I know from previous conversations with you, you've said that the more we go through this cycle, it's increasingly like the Fed is pushing on a string. Its efforts get less and less bang for the buck. But could they, if we start falling into a credit crunch, could they undo it with stimulative measures?
They will certainly peel the federal funds rate back. But this is going to be a different. This will be a cyclical event, not like the pandemic where outside forces everything down substantially. And so what the Fed, I believe, will cut the federal funds rate at discrete intervals. They'll respond 25 basis points. They'll wait a while, then they'll cut 50, then they'll wait a little bit more. They may cut 50 or 70. Who knows? But it will be a process. The thing that was unique about 20 and 2021 in the face of the pandemic is that the Federal Reserve stepped out of its lender of last resort role and became, to a certain degree, a spender of last resort. Now, we've seen that can be very inflationary. Inflation is too much money chasing too few goods. You cannot have a situation where the Fed prints money. So I don't think that we would. I think the Federal Reserve has probably learned that they have to stay within the confines of the Federal Reserve Act and take advantage of what they learned when they did not adhere to the law as it's written.
Okay, and does that mean that you don't think we're going to see QE anytime soon?
I assume maybe that eventually they will go back to it, but it won't be any more effective. And keep in mind that it's whether they're doing it in a lender of last resort role or a spender of last resort role.
Mm-hmm.
If they're directly paying the Treasury's bills, even though they camouflage it, that's going to be inflationary. But quantitative easing, in the sense that they did in Bernanke, which was all within the lender of last resort role formation, that was not inflationary. To put it in kind of a phrase, in 2021, the Fed crossed the Rubicon, and they were printing money, not entirely, but they were to a significant extent. If they stay within the confines of what they are, the authority that they've been actually given, and operate accordingly, then it will be a long, difficult process to restore the economy once the recession sets in.
Okay, and I'm just going to ask this again because, again, you understand the Federal Reserve way better than most people alive. They crossed the Rubicon.
I could be fooled too, and I have been. I was fooled by what they did in 2020 and 2021.
All right, but I trust your judgment and insight more than almost anybody else's here. So they crossed a line during the pandemic. It sounds like you're saying you don't think they're going to intentionally cross that line again anytime soon because they saw the inflation genie that they let out of the bottle, and they really don't want to do that again.
The federal funds rate's going to come down, but it will come down at discrete intervals, sometimes faster, sometimes slower. They will get to the point where they will stop quantitative tightening. That'll be another move that will occur, and it's possible that they restore the Treasury security purchases, but I don't believe that it will be like in the 2021 experience.
Okay, got it. So again, I'm digging into this because there's people that understandably say, hey, when we get into, if these lag effects are going to be real and they start really slowing the economy down, well, the Fed's just going to go back to what it was doing a couple of years ago. What I hear you saying is, don't count on exactly that playbook.
You hear that, and I hear it too, and I've been in debate with them, but keep in mind is that had a crushing impact on our modest and moderate income households. The expansion since the end of the pandemic was 11 quarters. In that 11-quarter period, your real average weekly earners income for all full-time hourly and salaried workers, which is about 120 million people, that declined by a record 3% in an expansion. Never before happened. Was there some initial benefit? Yes. But the vast majority of our people were devastated by the inflationary surge that arose from the Federal Reserve's actions.
Okay. Lacy, if it's okay, we're going to go a little bit long here just because this is a great discussion. I've got some questions I really want to get in here, and I know one or two you wanted me to ask you. One we touched on a little bit, but I'd like to flesh it out a little bit more. So anyways, you just talked about how the aftermath of what the policy decisions in 2020 and 2021 have disproportionately hurt the modest and moderate households, right? And they continue to just be hanging on by their fingernails here. They're the ones who are going to get disproportionately hurt by this right sizing of workforces, right? To try to address the productivity issue, right? So layoffs are going to hurt those households more directly. You talked about how commodity prices are having a little bit of an upsurge here. Oil prices have moved higher recently too. You talked about how that is a precursor in many ways to lower consumer spending, which then hits the economy and then, forces profit margins down, and companies have to then lay off here. So I asked if you thought layoffs were inevitable. Do you see a recession as inevitable from here? And is this just more sort of disproportionate trauma for those moderate and modest households here? Looking out, it's hard to have a sanguine outlook for the bottom 90%.
Okay, let me just give you a couple of statistics. From 1870 until the late 90s, the beginning of this century, in real per capita terms, GDP grew by about 2.2% per annum. In the 20 years since then, we've grown at 1.3% per annum.
Okay, sorry, what was the first number again?
2.2% per annum.
So 2.2 versus 1.3.
That was from 1870 to 2000.
Yeah, so we've basically seen a halving of real GDP growth per capita since the start of the millennium.
We've 1.3 versus 2. We're down, not quite a half, 40% or something.
Yeah.
So basically, I believe that the most critical element in this is the fact that we've increased government size, and there's a very strong deleterious impact that comes from debt. And so so here we were growing at 2.2, and now we're growing at 1.3. So what happens in that situation, and then we've had much greater involvement of the government sector. If you go back to 1971, when Nixon closed the gold window, and that was a very critical date, in my opinion. When the dollar was on the gold exchange standard, and there was a gold outflow, it created a public outroar, and there was a bit of a control mechanism from the outflow of gold to a restoration of fiscal sanity. But when Nixon closed the gold window, then there was no constraint from the dollar, and so government activity was able to increase. And so since 1971 through the present, the government size has increased from about 25% of GDP to about 34% of GDP. Now, there were a couple of very bright economists, Swedish econometrician Hendrickson and Berg, writing in the peer-reviewed Journal of Economic Studies, had estimated in a paper written in 2011 that for each 1 percentage point increase in government size, that we would lose 0.05 to 0.1% of real per capita growth per year. And this outstanding work has actually been validated by the time period since their work was published. We have lost 0.9% per year. We're at the very upper end of their range. In other words, we increase the government share through either direct deficit or by cooperation with the Federal Reserve. You get a bigger government share, you get a smaller private share. The per capita growth rate comes down. And it's been historically shown time and time again, when the per capita growth rate comes down, you exacerbate the income and wealth divides.
Yeah, which we've obviously seen, right, over the past couple of decades. This seems to be great validation of your comments that the government is indeed a negative multiplier.
I think it is. It's also consistent with the excellent work in 2012 of Carmen and Vincent Reinhardt writing with Ken Rogoff. They found that if gross government debt moved above 90% of GDP for more than 5 years, that you would lose a third of your growth rate against trend. Well, that's the same data that we're talking about from Berg and Hendrickson. We've lost slightly more than a third as a result of the debt or government size, which are intricately interconnected. And so we may think that the government is the solution to the problem, more government intervention, but more government intervention is actually creates more of its own problems. I mean, I think what's happening in China is a clear-cut case of the fact that reverting to more command and control, more and more government debt is counterproductive. We saw the Japanese who lost more than 3 decades with that type of policy. Europe, the data, those studies apply to what's happening in China, Japan, Europe, and the United States. You go in this path, you're going to get this result.
All right, and Lacy, you talk about those 2 studies in some depth in your letter, and a question for you, since I've been mentioning it so much. Is it all right with you if I make this letter available for download?
Yes, so we make it available as a public service.
Okay, great. So folks, if you want to download this for free.
It's an educational document.
Okay, thank you. So then folks, if you want to download this for free following this conversation.
We make it available. We have done that over the years. It's also published on our website as well. So
okay, great.
We're not hiding it from anyone.
All right, great. So then
and you can read the current one. Everything's there. Warts and all.
Right. So folks, what we'll do, go to wealthion.com/Lacy. We'll have a downloadable version of this and a direct link to Lacy's website as well, so you can read it however you want it, and obviously go explore Hoisington if you can.
So you use management's website.
All right. Well, look, Lacy, one other thing that you've mentioned a couple of times, but we haven't really, I think, maybe given it its full shrift here, is the fact that bank credit lending is tightening here, right? So this is a separate powerful contractionary force that is layered on top of what the Federal Reserve is doing here. So how substantial is this, and what does history tell us to expect when this happens?
Well, it is very interesting. In fact,
our interview with Lacy will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. Now, much of the discussion in this video centered around Lacy's recent Q2 letter to Hoisington's investors. He's generously made that letter available to the general public, so be sure to go get yourself a copy for free right now over at wealthion.com/Lacy. And finally, if the challenges that Lacy's detailed in this interview have you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities Lacy's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Lacy Hunt.